Hey, what's up? Welcome to DGenEd. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts like the chart behind me, which is of NIO, ticker symbol NIO. And so here we are looking at the daily chart on Tuesday, June 11th, after NIO closed at a price of $4.46, being down about 5.5% on the day and continuing down 1 penny in the after hours, closing the after hours trading session at $4.45. And so I wanted to go over this chart because, I feel like I made some bad calls with NIO. And also, I've been learning about options and I wanted to kind of share an idea that I think could be a really great way to buy the dip if NIO does go lower. And also, I do think it could be a really nice way to pick up some shares, even if it doesn't go lower. So I wanted to go over that. But before I do get into the options, I'm just going to go over the chart and kind of, the mistake that I feel like I made, but, I'll really find out on the 21st if it was a mistake. And so that is based on me expecting that following earnings, price to go up. I expected price to be going up to this neckline here, right around $6 a share, thinking that it would be breaking above that as I had drawn that purple line there as a neckline, inverse head and shoulders. I expected price to be shooting up there, but instead we actually got a gap down, and it does look like we are breaking lower than this white downtrend that has held as support for quite some time, although we have broken below it a couple times, most notably right here. And so, I do think we may be breaking down a little bit more, but I don't think we're going to be going down to 361. I do think that there is actually a gap that could be filled, and it's at a pretty interesting price. I think it could represent a great dip buying opportunity, and I think options could help to execute that strategy. But so, what I was thinking about with earnings, that was really based on the max pain for the 21st that's coming up, not this Friday, but next Friday. That's for the monthly contracts. And so I had bought a call with a strike of $5 a share. At the time, that was in the money. I felt like it was a safe bet. And the reason why I felt like it was a safe bet, because if I do flip over to max pain, I can see that for the expiration of June 21st, the max pain for NIO is actually $6 a share. So I felt like a strike of $5 a share was a pretty safe bet. It's quite possible NIO does turn around and that what we're seeing right now is a fake out break and that we do bounce, reclaim this downtrend and reclaim $5 a share, maybe even getting up to $6 a share before next Friday. But, we can also close below max pain. That is quite the possibility. And so I kind of just wanted to share an idea that could represent a really good way to, take advantage of how the chart looks right now and make a little bit of money doing it and maybe even accumulate some more NIO. And so my thought process on buying a $5 strike call was not only that max pain was above that it would likely close in the money, but that I was happy to pick up shares at a strike of $5 a share. So that's buying 100 shares at $5, totaling $500. But then also the premium added on to that was about $70, so putting the total price per share around $570. I was willing to pay for that because I felt like price would be going higher, but I suspect that call will be expiring out of the money, and I'll be out of the money, losing about $70 there. But that's really no big deal because I'm learning a lot, and that's what this channel is all about. And so one thing that I have been learning about is selling cash secured puts, because that can be a great way to buy the dip. And there is a level here on the chart that I do think could correspond with a strike price that could represent buying the dip. And so I wanted to go over that. And so here, looking at the chart, I do have this Fibonacci retracement here. I did add some levels to it from the last video that I went over. One of those being the 65% level, which is at a price of $4.46.4. So being just a tiny bit above the price that we closed at today, but effectively, being at that price. And the reason why I added that level is because the 65% retracement to the 618, that represents the golden pocket. And so that is where we are currently at. We did dip below it today, but we closed right around that 65% retracement. So I do think it is possible that this is a fake out break below this trend line. But I also do think there is a level to the downside that looks pretty substantial. And I am a little bit concerned we'll be going there. But, I do think that there's an opportunity, a way to take advantage of that. And so that level is right around the 786, which is at a price of $4.13.2, which, you may not be able to see it because the numbers are covering it up here. So if I do remove my drawings, we can actually see that there's a gap right around that level. And so the close on April 25th before this gap up was at a price of $4.13. So there's a gap there that needs to be filled. And actually there's even a gap a little bit below it. Here we did have a close on the 23rd of April at a price of $4.01. And then the low the day following was $4.05. And on the 25th, the low was $4.03. So there are there's one small gap down here to $4.01, and then a bigger gap here to $4.13, which does correspond with the 786 level. And so that got me thinking, maybe price, will not be going to $5 a share. My call option will be expiring worthless. And while that is kind of nice, if I were to exercise it, I'd be buying 100 shares at $5 a share, totaling $500 there, plus the cost of that premium. It would actually be nice, if it dipped lower, then I could pick up 100 shares maybe, at $4 a share. And so that does correspond with a 786, and that could correspond with selling a cash secured put. So I did want to go over those. So I'm just going to flip over to the options table here, and I am looking at puts, as you can see up here. And these are for the expiration of June 21st. And so I just wanted to go over some of these and do a little bit of math to kind of, calculate how much we'd be paying to buy 100 shares. Let's say if we wanted to do that, whether, that's at the current price at $4.46, which would cost $446, or maybe we could play around with selling some cash secured puts. And so I'm just going to explain those to you guys because I think that they're really, really cool. And I actually think it's a better way to accumulate shares than to just straight up buy them. And so basically what a cash secured put is when you look at a strike price, like let's say the $4 strike price here, I think the price might be around $4 a share to fill this gap, maybe by the 21st. And so with this put here at $4, that to sell that put, I would need to have $400 in my account to have a cash secured put. And I would be saying that, I'll take this premium, which is 4 cents times 100, that's $4, so it's not that crazy, but it's something. And so I would be signing this contract effectively, saying that, if the market makers give me $4 per contract, I will set aside $400 to secure that put. And if price closes below $4 a share on the strike date, on the expiration date, which is June 21st, if price closes below $4 a share, I'll then buy 100 shares at a price of $4 a share. And so, like I said, if we were to buy 100 shares right now, that's at a price of $4.46. If I think there's a possibility price will be going lower to $4 a share, I could then, buy 100 shares down there. That would cost $400 to do that. Or I could do a cash secured put where I would be paid $4 and then I would buy 100 shares at $4 a share. And so if I flip over to my calculator, I can calculate that by 4, times 100, $400 per those shares, but then I would subtract the premium that I would get, which would be $4 because 4 cents times 100. And so I'd be getting those 100 shares not at an average total price of $4 a share, but actually for $3.96 per share. So I think that's actually a pretty nice way to accumulate shares. And there are also some other options here on the table that we could explore that, may actually be surprising. You can actually pick up shares for cheaper than 446, even if it doesn't go down to $4 a share. And so one way to do that is, let's see, looking at this $4.50 strike. Current price is below that. And so that's, a little bit risky because it's an in the money put. But if I were to sell a put, I'd get $22 for that premium, and I'd have to have $450 on the side as a cash secured put, that if price did close below $4.50 on the 21st, I would then have to buy 100 shares at $4.50, totaling $450, which is more than, it would cost to get them now. However, with that premium, flipping back over to the handy calculator, I'd be paying 446 right now, but if I bought cash secured puts and it closed below 450 on the 21st, I'd be buying them for $450, but I'd get this premium of $22. So I could subtract that from the total amount, and then I could actually get 100 shares for not $450 or $4.50 each, not for $4.46 each, but for a grand total of $428 at an average price considering the premium of $4.28. So I find that to be a pretty intriguing way to buy shares. Another way to do it is, if we're looking at, this might surprise you, if we're looking at the $5 strike price, that's well above the current price, over 50 cents above it. But, to sell a cash secured put there, I would need to have $500 on the side to then sell that cash secured put. But doing the math here, what's 500 minus 57 that I would get paid as premium for that? If I pull up that calculator again, $500 minus 57, that's $443, or an average price of $4.43. That's actually lower than the current price. So, I think that selling cash secured puts is a really nice way to have discipline and executing these orders, executing buys, rather than just FOMOing in at current price. Buying with a strategy. And if price does go up, if it goes to $6 a share, if I'm a shareholder, that benefits me. But if I sell a cash secured put and price goes up to $6, that's fine, because I'd be making money on this premium. Whether I make $4 with the strike of $4, $22 with a strike of $4.50, or $57 with a strike of $5 a share, assuming price, closes above $5 a share on the 21st, I would then be making $57. And I'd also have this $500 set on the side, not going anywhere. But, if I'm happy to buy 100 shares at the current price, this could be a nice way to make some money. When buying those shares. So I think that's pretty cool. And, just looking at the chart here, I do feel like it is unfortunately pretty likely that we will be retesting $4 or $4.13. And actually, I do think that could be not such a bad thing, because that would fill this gap, potentially filling the gap down to 401. That would be putting in a higher low, though, as this low was 361. And I do think that we could be finding some support there, as there was a little bit of consolidation here. I do think that could be acting as support. That could be acting as a great dip buying opportunity before we finally start to move higher, potentially up to $6 a share and beyond. And so, I am excited about NIO's future, and I do think that the stock will be going higher if we do take a step back and look at the chart. I do think that this pattern that we're seeing, I think we're at the lower end of it. And, I think that we're looking at discounted shares. And I think a year from now, the price could be much higher, and picking up shares, whether it's at $4.50, even $5, or, down to $4 a share, I think that's a great deal. So I'm just excited about that. And I'm excited to share the new information that I've learned about selling cash secured puts. And so, I hope that was helpful for you guys. But, those are just my thoughts. If you found them helpful, make sure you like the video, share your thoughts in the comments down below, and subscribe to the channel for more videos like this. Thanks a lot for watching.